All right, good evening, everybody. Welcome to Investors KopiTime at 8 p.m. on Wednesday. And today we're going to talk about futures for those more gung-ho traders who want to take a look at what futures market has to offer. Right. So today, basically, I'm just going to share with you what can you expect trading in the futures market, because we're going to have actually a series of these. All right, probably another 4 or 5 more on futures trading. All right, so it's just going to be sharing with you what to expect in futures trading and how do traders trade in the futures market. And of course, if you want more details, we will talk about a lot of other things, right, in the coming live session. All right. So today I'm just going to share with you, why do future traders, or why most full-time traders, all right, trade the futures market. All right. So if you have any questions on all the presentation along the way, because I'm now I'm solo mode again, so I'll take a look at your questions. So if I need to answer any questions, then I'll answer your questions and then I'll move on. All right. So yeah, once again, welcome guys. If you know who's interested to trade with leverage, make sure you share this to your friends, right? So they're able to join us as well. All right. Okay, so we're going to start off with what is futures, right? So I'm just going to give a plain explanation. And I'm sure that sometimes when you read, when you Google about futures market, you try to understand what they say also is quite difficult, unless I show you what is meant, all right, on the graph and on the slides, so it's easier for you to understand. Okay, again, this is not all the futures market that is available. I'm just going to focus on one that later I'll just share with you, but the idea is about the same lah. All right. So, what's a futures contract, right? Now, so unlike stocks, right, when you buy a futures, you're not buying any shares, you're not buying any stocks. What you're doing is actually entering into a contract. All right. And you can enter into a contract anytime you want. Okay. You can buy or sell. Okay. And here, because we are not so familiar with selling or short selling, if we are trading mostly stocks, right? So in the futures market, you don't need to have, or you don't need to hold any asset to go short, right? We call it a naked short. That means you can just open a contract that says you want to sell now. So if there's any buyer who wants to buy your contract that you want to sell, then they'll buy from you. Okay, so it's all traded in the exchange. So of course, we are looking at Malaysia market. We are trading on the Bursa Malaysia Derivatives Exchange, right? And to open an account, later I'll share with you where you can actually look for more information and also open an account. How you can actually trade the futures market or futures contracts. All right. So it's a legal agreement to buy or sell a particular commodity, asset, or security. So I'll mention this in a short while, right? At a predetermined price at a specified time in the future. Okay, so again, this already is a bit difficult to understand, but let me just show you later on. Okay, so futures contracts are standardized for quality and quantity to facilitate the trading in the futures exchange. That means, if you are trading, let's say palm oil, then you need to have a certain specification on the palm oil, right, to actually trade. Okay, because when you wanna buy the palm oil, you need to be at the specific specification. All right, I'll explain that also in a short while. And then if you want to sell also, you have to sell it with a specific specification. Okay, so the buyer of a futures contract is taking the obligation to buy or receive the underlying asset when the futures contract expires. Again, I'll explain to you what is this all about. All right, so once the contract expires and you hold the contract until it expires, you are obliged to buy. Okay, now this is different from warrants or options. Okay, options or even warrants gives you the right, right, but not the obligation to buy or sell the underlying asset. So that's the difference. Okay, so you can, if let's say your options contract expires, okay, you don't need to actually buy or sell the underlying asset. All right. In the futures market, you must. Okay, you're obliged to. Okay, you cannot say it. I don't want. Right. So you have to take it. Okay. So the buyer of the futures contract has the obligation to buy given it expires, and the seller of the futures contract is taking the obligation to provide and deliver the asset at the expiration date. Okay, so I'll just share with you what it's all about lah. Okay, so the underlying assets, it can be any commodities, any assets, it can be stocks, right? So Malaysia currently, of course, you can do short or intraday short selling on the exchange itself, on Bursa Malaysia itself, all right, but you can only short intraday. That means you have to sell at the end of the day, all right? But if you are trading in some countries, if they have a futures market for stocks, and I think Bursa Malaysia is also going to come up with something, right, on stock futures. Okay, but right now, if you go to US or whatsoever, of course the market is bigger. You have actually a futures market to go and trade stocks. All right, in a futures market like Facebook, Tesla, whatever stocks lah. All right, the underlying asset can also be an index. Okay, for example, you want to trade the S&P or KLCI, because you cannot actually trade KLCI. Right, you look at the KLCI index itself because it's just an index. Okay, but there's a futures market, okay, where the underlying is KLCI, and you can trade in that futures market. Okay, so same thing like commodities market, right? Yeah, you have different kind of commodities. You have gold, you can have trade futures on crude oil or palm oil, cotton, and soybeans and so on and so forth. Okay, but of course, some of these contracts are not available in Malaysia. Like for example, gold, the biggest futures market for gold is in the COMEX market, right? The COMEX futures exchange, which is in New York, which is in the US lah. All right, and then there are futures on forex as well. Okay, the different pairs. Okay, cryptocurrencies also have a futures market. So as long as there's a commodity, right, where it has price, has value, the exchange itself will actually develop that product. All right, so Malaysia, for example, we are well known for palm oil production and also trading, right? So they created the futures market to cater for this palm oil market. Okay, and the reason why they created a futures market is to basically mitigate some risks, so that the producers or the traders can actually hedge. Okay, so today I'm not going to talk about hedging too much, all right, because we have another topic for it. Okay, why is hedging important for some of the producers or some of the people who actually trade the underlying asset to mitigate their risks? Okay, that was what the futures exchange is all about. So of course, in an exchange, is not just for that physical market players, but it's also for speculators. So for example, if I'm trading crude palm oil, right, and I do not own any palm oil plantation, or I do not really trade physical palm oil, if I'm trading the palm oil futures market, I'm considered as a speculator. All right, so a good name for a speculator is basically a trader, right? The trader, it depends lah. I mean, if you can speculate without knowing anything, or you can become a pro trader where you actually have a trading plan. All right. So it is traded in the futures exchange. So for example, you have COMEX in the US, CBOT, NYMEX. These are all under the CME group, the Chicago Mercantile Exchange, right? And then we have Bursa Malaysia derivatives. We have the Intercontinental Exchange. You have TOCOM. Like TOCOM is famous for rubber futures, all right? And many other futures markets. So most of the countries, they have their own futures market. Okay. So I'm just going to give an example today on palm oil futures, because this is one of the most heavily traded contract in Malaysia. Okay, and then a lot of you guys know what is crude palm oil as well, right? I don't want to give an example of gold or crude oil. Crude palm oil is easier to start. Okay, so for every single contract that's available to trade, there's always a contract specification. So later I'll show you where you can get more information. Okay, so I'm just going to give you a very simple contract spec. For traders, this is what they need to know lah. All right. So when we are trading one contract, okay, in palm oil futures, one contract is equivalent to 25 metric tons of palm oil. So it's like 25,000 kilograms of palm oil. Okay, that's the contract size. Okay, so the contract value per contract, one contract, is you take the contract size, which is 25 tons, multiply by the current price, right? Because the current price is quoted by ton or per metric ton. Like for example, right now, let's say the price is 2,000 ringgit per metric ton. Okay, the price that you see on the on Bursa Marketplace or on Bursa Malaysia website, you see the price there, 2002 or 2003 currently. That's the current price per ton. Okay, so the contract size, if you're trading one futures contract, is 25 tons. So you take 2,000 multiplied by 25, the contract value is 50,000 ringgit. Okay, so that means if you just trade one futures contract, the value that you're actually trading, okay, is 50,000 ringgit. All right. So how do I trade the futures contract? So of course you have to open an account in a futures broker first. Okay. At the end of the presentation, I'll show you how to find one. All right. You are required to open a futures trading account in any futures broker, okay, which is participating in Bursa Malaysia derivatives lah. Okay, and you need to put a deposit. Okay, we call that the initial margin to start trading. Okay, so now for CPO currently the initial margin is about 5,600 ringgit. So that means you put in 5,600 ringgit. Well, first of all, you open an account and then you deposit in 5,600 ringgit. You are ready to trade one contract. Okay, if you put in, let's say 12,000 ringgit, then you can trade two contracts. If you put in 18,000 ringgit, then you can trade three contracts and so on. Okay, so that means if let's say you put 5,600 5,600, right, initial margin 5,600, say when you trade one contract, the value of the contract is 50,000. Okay, so that means, you see, although the value of the contract is 50,000, I don't need to deposit 50,000. I only need to put the initial margin in, which is 5,600. So 5,600 to trade 50,000 worth of a contract, that gives you about 8.9 or 9 times leverage lah. Okay, you take 50,000 divided by 5.6k, you get 9 times leverage. All right. So leverage is basically like this, right? If the price now is 9 times leverage, right, you're getting, if the price goes up 10%, that means you will make 90% from your deposit. Okay, and let's say that deposit is your capital. All right, so I'm going to give you some examples as we go on. So, okay, let's say we have 3 different traders here, and remember every futures contract has an expiration. Okay, and if you are trading palm oil futures contract, for example, we have the spot month contract, the next month contract, the third month contract, fourth month, and so on. All right, they have a quarterly month. So you actually at one particular commodity, you have many months contract that you can trade. Okay, so if you are trading palm oil, for example, and if you are trading, let's say, the May contract, okay, it simply means that the contract will expire in May. Okay, and for palm oil futures, the contract will be expiring at the middle of the month, which is 15th of the month. Okay, if it's a business day, then if it's not a business day, it's going to be after that lah. All right, but the contract expires on the 15th of the month. Okay, so let's say now we have 3 different traders lah, right? Benny, Alvin, and Peter. All right, and we are trading the July contract. Okay, we are trading the July contract. That means this contract is going to expire on the 15th of July. Okay, and the one that below that shows you the current price. So let's say now the price is 2,000 ringgit. Okay, so Benny is bullish. He thinks that the price is going to go up. So he's going to buy one futures contract or buy 2 futures contracts in this example. So I'm buying 2 contracts, right? So the value of the contract is basically how much? 100,000, right? Remember, if you are trading one contract, the value is 50,000, right? So if you are trading 2 contracts, that means the value is 100,000. So I long. Okay, the term that we use in futures trading to buy is to go long. Okay, and then Alvin is a little bit more bearish. He expects the price to come down, so he sells. Okay, he sells 2 contracts now. So he just key in the sell on the trading platform. Okay, 2 contracts at 2,000 ringgit. That means now he's going short. Okay, on the palm oil futures, and the value is also 100,000 because he short 2 contracts. All right. Okay, so now Benny and Alvin, we can actually hold the contract until the expiring or the expiration date, which is on the 15th of July. But from the moment they buy until the expiration, they can buy and sell anytime because this is traded in the exchange. Okay, I can even buy now and sell half an hour later, or buy now, sell tomorrow, or 2 days later, or 3 days later. Okay, as long as the contract has not expired. So let's say, for example, on the 14th of May, all right, on the 14th of May, the price went up to 2,001. Okay, let's say lah. So now I decided to sell because I think, okay, 2,001, maybe it's my target, 2,001. Okay, so I'm going to sell or cover the long position. Okay, sell lah. Okay, so when you sell a contract when you bought earlier, it cancels off the other one. It cancels off your earlier buy. So that's why it's called a cover long position. Okay, so I'm going to sell to the 2 contracts I own. Okay, at the market, I can sell it to anyone else, anyone who's willing to buy. And it's like the share market, right? It's a stock market. When you want to buy and sell in the futures market, there's also the buy price and the sell price. Okay. So if I'm going to sell now at 2001, the value of the contract if I sell now is how much? Because the price now is 2001, right? Okay, so you multiply by 25 tons times 2 contracts, the value now is 105,000 ringgit. So that means if I sell now, I'm going to make profit of 5,000 ringgit. Okay, now to make it easier, right? In a futures contract, if you're trading one contract, 1 ringgit movement in the futures contract for palm oil, right? 1 ringgit movement is equivalent to 25 ringgit because it's 25 tons. All right. So if you take 2 contracts, multiply by 25 metric tons times the difference in price, because remember, I bought at 2,000 and then now it's 2001. So the difference in price is 100 ringgit. Okay. So 100 times 25 times 2 is 5,000 ringgit. So I take a profit of 5,000 ringgit. Okay. Now, Alvin, because the price went up, because remember, he shorted the market because he expected the price to come down, right? But the price went up. So he said, I think I better get out. So I buy back. Okay, Alvin buys back is to cover the short. Okay, 2 contracts as well. Okay, so this is not 1 contract. I'll make the amendment on the chart. Sorry, this is 2 contracts. Same thing lah. So he's also sell 2 contracts. Okay, so now because he short earlier, right, and the price went up. Okay, it went up same price, but because he shorted, he lose 5,000 ringgit. Okay, because you see, if you look at this, right, when Alvin initiated, he sell first. Okay, at 100,000 ringgit. Then after a month later, on the 14th of May, he buy at 105. So it's like buying at 105 and selling at 100. So that means you are losing 5,000 ringgit. Okay. So once you finish, you sell your contract, that means you don't worry, you're already out of the market. Okay, you're already out of the market. Now, then Peter decided to buy. Okay, because he still think that the price can go higher from 2001. And probably Peter is let's say he's a trader on real physical palm oil and he wants to take delivery. So he'll just wait until the contract expires. Okay, now why is he doing this is because if Peter expects the price to go up, okay, on the 15th of July when it expires, right? Let's say he expects the price to go to 2003. So Peter wants to lock in the current price at 2001. So when it expires on the 15th of July, although the price is at 2,300 ringgit, but because the contract is at 2001, he can buy the contract at 2,100 ringgit instead of 2003. All right, so he's actually buying cheaper than the current market price on the 15th of July. All right, so let's say Peter buys 2 contracts. So you take 2 times 25 times 2,100 ringgit because the current price is at 2,100 ringgit, right? So the value that he's buying is 105,000 ringgit. Okay. So come expiration date, what happens? Okay. So Peter just let the contract expire. He did not sell to anyone before it expires. So now Peter has to get ready to buy and receive 25 metric tons times 2 contracts. That means he's ready to buy 50 metric tons of crude palm oil at 2,100 ringgit. Okay, so now Peter has to come up with 105,000 ringgit. Okay, to get ready to buy palm oil, real physical palm oil. Okay, then this is the exchange is the one that becomes the medium lah. All right, or the exchange to do the transfer. All right. So he has to now come up with 105,000 ringgit to buy that palm oil. All right, to buy that palm oil. Okay, but you see, if you buy the palm oil at 105,000 ringgit, right? But the value of that palm oil itself now is actually 2,300 ringgit, right? But he got it at 2001 because he entered a futures contract earlier at lower price. Okay. So if you have any questions about this, you can just ask the questions. Okay. So this is as easy. I try to make it as easy as it is to understand. All right. So when you buy a contract, for example, right, like let's say the expiry on the 15th of July, you can buy and sell, okay, and buy and sell your contracts in that 15 days, okay, without it expiring. Because the moment it expires, you have to take delivery. Okay. Now, in the futures contract, there are 2 types of delivery. Normally, one is called a cash settlement. Okay. The other one is a physical delivery. Now, for example, palm oil futures contract is physical delivery after expiration. That means when you buy, for example, a futures contract and you let it expire, you have to get ready to buy. Okay, and if you sell the contract, you're on a short position and you let it expire, that means you have to get ready now to provide, okay, palm oil futures, crude palm oil to the buyer. Okay. Cash settlement means you don't need to take any delivery. At the end of the day, your position will just be squared off. Okay. Normally, most of the index futures, it has cash settlement. Meaning, for example, like you're trading KLCI futures, right? So at the end of expiry date, you settle in cash. So for example, if let's say you lose now on paper, you lose 5,000 ringgit. So what happened at the expiry date is your account will be deducted 5,000 ringgit. Okay, but if you let's say in a position where you are in the money, right, you are 5,000 ringgit positive. So at the end of the contract or expiration date, 5,000 ringgit will be added to your account. So it's all settled in cash. All right. So two types of settlements. Okay. So now remember, if I want to trade two contracts, right, I need to have at least 11,200 ringgit. Okay, but let's say I put a deposit of 12,000 ringgit lah. Okay, because remember the initial margin is 5,600 currently. Now the initial margin will be set by Bursa and the brokers from time to time. Okay, if the market gets really volatile, your margin has to be bigger. Okay, and normally they set it like a monthly basis lah, all right, or 2 weeks basis. Okay, so they change. Like for now, it's 5,006. Maybe in the next 2 or 3 months, it may be 6,000, it may be 7,000. Okay, so as long as it's volatile, the broker will set the margin. All right. So right now it's 5,006. So if you want to trade two futures contracts, let's say I put in a 12,000 ringgit capital, 12,000 ringgit, right? So remember, I bought two contracts on the 26th April at 2,000 ringgit. The value of the contract is 100,000. Okay, on the 14th of May, the price went up to 2,100. So in terms of price, right, from 2000 to 2001, the increase is 5%. All right, 5%. The value on the 14th of May right now is 2,100 ringgit, right? So that means it's 105,000 ringgit. That means if I'm going to sell now, I'm going to make 5,000 ringgit, correct? 5,000 ringgit. Yeah. Remember the value of the contract that I bought is 100,000 and now it's already 105,000. So I'm going to make 5,000 if I sell now in the market, okay, in the exchange. Okay. So that means I'm making a 5,000 ringgit, but what was my capital? Okay, remember I put in only 12,000 ringgit in my account as a capital. Okay, and I'm making 5,000 ringgit. So that gives me, if you use your return on your capital that you put in, okay, you make 5,000 and your capital was 12,000. That means your return on the capital is 41.6%. Okay, so that means that with a 5% increase in price, my return is 41.6%. Okay, if there's a 10% increase in price, that means my return is going to be 83%. Okay, so that means this gives me a leverage of about 8.3 times. Okay, so depending on the deposit that you put in, okay, if you put in, let's say 20,000 ringgit, right, but you only buy two contracts, okay, then your leverage should be lower. Okay, now this one I will go to the next part of the not probably the next session, right, to talk about how you can manage the risk. Okay, the only way you can manage the leverage, right, the risk, is by putting more deposits lah. Okay, but because leverage is a double-edged sword, okay, later I'll share with you. Okay, so why do traders trade futures? So I'm going to explain one by one, and then you'll see what I mean. Okay, let me just answer some of the questions first, if you guys have any questions, so that I can go on. Okay, Teo Eng Ho, it is volatile for KSI recent month. How can we manage it? Okay, okay, later I'll show you the kind of volatility that we're expecting. I'll show you some data, then you understand, right? So again, it depends on your trading plan, okay, how you manage the kind of volatility. In fact, actually, traders prefer when it's volatile because you can make more money, okay, even in intraday basis. Hence, negative price is future contracts of oil recently. Yeah, correct. Yeah. Because they have to actually either take delivery, right, or they have to just sell their contracts right now before it expires. Because if I take delivery on oil, let's say crude oil, remember the crude oil, it's probably going to be more expensive that I take the oil, right, physical oil, because I got no place to store. I do not know what to do with the oil, so I'll just take the loss. All right. So even it's a negative loss, I give you money to take my oil. It's still cheaper than I take the oil and try to figure out where to store it. That's what happened in crude oil, right? For traders who trade in USD futures, can you recommend trading house FI that offers more? Okay, this one mainly you have to go and look for the broker that you are familiar with, or maybe more convenient for you, or what kind of service they can provide for you. All right. So later I'll show you where you can find this information. All right. How to get started traded, Santik. So I'll show you later. This will be at the end of the presentation. Okay. Mark Francis, Alvin, those who bought at negative prices are laughing to the bank. Not necessary, because if they go and buy at negative prices and the price contract closed at negative figures, you still don't make money, all right? Unless if the price rebounded, which it actually did, right? In negative, went back to positive for slightly and then came down back. So that's how volatile the markets can be. So I'll show you later on example how volatile the market can be. If didn't manage to sell and expired, then how? Okay, so that means if let's say you sell the futures contract and it expires, now you have to figure out where to get the palm oil to deliver. Okay, that means you have to go to maybe FGV or or IOI Corporation or KLK. Okay, to get. Okay, so but normally for traders like us, we don't go until it expires, right? We will sell the contract before the thing expires. How much is brokerage fee? Again, it depends on broker, but normally commission can be like 1 or 2 points, 25 ringgit to 50 ringgit if you're holding your position overnight, right? Because it's now negotiable a little bit. So if you trade a lot, of course, the broker can give you better rates, all right? If you're trading intraday, that means you buy and sell within the same day, you get a better rate also, all right? Much better rate. Okay, what will happen if you forget to sell? Do not have physical part to deliver, then you have to go and discuss with Bursa Malaysia, okay, and see whether you can do any cash settlement with any of the buyer or not, or seller. Okay, because the futures contract is like a zero-sum game, right? Whenever there's an open position means those who bought and haven't sold their position. That's called an open position. So it's always whenever there's a buy, there's always an opposite position, which is a sell. All right. So it always squares out at the end one, all right? For those start with short upon expiry, how the physical stock is being traded. So like I said, you have to go and find out where to get it, okay? Or you can actually discuss with Bursa, and because Bursa will become the mediator to tell, can I settle cash with some of them or not? That means you have to pay the difference in prices, okay? Okay, how much account need to have a deposit to 300,000 ringgit? So in the current value, it depends on the prices, right? Because if the price is higher, the value of the contract is higher. So right now, palm oil is 2,000 ringgit. Okay, 2,000 plus 2,002 lah. Okay, let's say 2,000 to make it easier to calculate. So 2,000 you multiply by 25 because 2,000 is the price per ton, 1 ton. But you're trading a contract which is actually 25 metric tons per contract. So you take 2 times 25 is 50,000 ringgit. If you're trading one contract, the value of the contract is 50,000 ringgit. So if you're trading, remember, you need 5,600 ringgit to trade 100,000 ringgit, 50,000 ringgit. So if you want to trade 100,000 ringgit of value of palm oil, then you have to put 2 times the initial margin. Okay, so 2 times 5,006, okay, is 11,200 lah. All right. If no buyers, then have to take delivery. Yeah. Okay. Now, Philip, if let's say the contract is going to expire in July, and you bought a July contract, right? And the contract is going to expire on the 15th of July. Let's say I'm talking about palm oil, all right? So what happens is the closer it moves towards the expiry, the less volume, right? The less liquidity, because people will be trading the more active one. And for palm oil futures, the 3rd month contract is always the most active one. All right. So for example, today is April 29, right? And April 15 contract expire already, right? Because in the middle of the month. Okay. And today is April 29. So the current month contract is the May contract, which is going to be expired on the 15th. Okay. And then we have the June contract, okay, which is next month's contract, which is going to expire on the 15th of June. That's the 2nd month contract. The 3rd month contract is a July contract, which is on the 15th of July. So the July contract, because it's the 3rd month contract, that's where normally most of the trades are being done, on the 3rd month contract. Okay, so the June contract, the May contract will get lesser in volume. Okay, and the August contract and September contract is also lesser in volume. Okay, so now the problem with when you get low liquidity is your bid and ask will be high lah. Okay, your buy and sell price, because there's not much liquidity. And that's the problem with crude oil. Remember the crude oil when it go negative, because when the contract is about to expire, right? On May, for example, the spread is very big. Okay. The buyer maybe want to buy at $20, but the seller want to sell at $40. So if I got no choice, I want to sell now, I have to take the buyer's price at $20. So be it. I lose $20 immediately. All right. So volume is important. 25 metric ton is okay. Tong Ji Hong. So the value is depending on the current price. Okay. So if let's say the current CPO price is 2,000 ringgit, you take it multiply by 25 metric tons, you get 50,000. Okay. If let's say today palm oil prices is 4,000 ringgit. Okay, 4,000 ringgit. So you take 4,000, okay, multiply by 25. That value of the contract now is 100,000 ringgit. Okay, so it's 25. So the value is depend on the current price. All right. Okay. Yeah. So if you buy, let's say if you forgot to if you bought 25 tons of palm oil and you forget and you let it expire, then you get ready to buy the palm oil. Okay. So if you buy one contract, that means you have to at 2,000 ringgit, right? You buy one contract, that means you have to get ready 50,000 ringgit. All right, that's the value that you have entered the contract into. You have to get ready 50,000 ringgit and get ready to receive 50,000 ringgit worth of palm oil. That's 25 tons of palm oil. So you probably have to fill up or get the swimming pool ready lah. Okay. Fast money up, fast money down, Francis. Yes. Okay. It depends on how much leverage you want to take. Now, Kim Boon Cheong, what's the spread? Normally for futures market, the spread is just the next tick. For example, like palm oil, the minimum movement in palm oil is 1 ringgit, 1 ringgit, 1 ringgit. So normally the buy and ask is 1 ringgit one. Okay, if you are trading at the third month contract, the active month contract. But if you are trading, let's say now you are trading, let's say October contract or September contract, the spread can be maybe 20 points or 20 ringgit difference or 10 ringgit difference. Okay, remember the further it is from the active month contract, the less liquid it becomes, then your spread will be bigger. But on the active month, normally it's only one tick. What is the capital, the amount deposit into the account and not the initial margin? No, the capital can be, you can have 100,000 ringgit capital ready, but you don't need to put 100,000 inside if you want to trade one contract. You just have to put 5,006 to trade one contract. Okay, so it depends up to you. Okay, you can put in 100,000 inside your account. Okay, by right, 100,000 you can trade maybe like 20 contracts. All right, let's say right, about 20 contracts. But with the 100,000 ringgit, by right you can trade 20, but I can also just trade one if I want to. Okay, so then your leverage becomes smaller. So it depends on how you want to manage your risk. With for intraday trading FKLI, which chart should we use? 5 minutes or 15 minutes? William, that one okay, the tactic part and all that I cannot discuss here because this one is more on why you're going to trade. I'm going to show you later on some examples later on now. Okay, how can 12K capital to trade value 100,000 contract? That's why it's leverage. When you're trading the futures leverage, okay, when you're trading the futures contract, it's all about leverage. Okay, so that's why with 12,000 ringgit, but you can actually trade 2 contracts, and that 2 contracts is actually valued at 100,000 ringgit. Now, bear in mind, there's a thing called a what's the term that they use it? Maintenance margin. All right, there's also a maintenance margin. That means at a certain point of time, all right, your account has to have that minimum. This is to actually safeguard the brokers lah. Okay. Let's say you are trading futures, okay, because in the CPO there's actually different tiers for maintenance margin. Let's just make it simple. Let's say the maintenance margin is 2,000 ringgit. That means at any point of time, your account has to be at least 2,000 ringgit on paper. Okay, for example, let's say you put 5,600 ringgit into your account, okay, and because you are in the wrong direction, and now your account is at because at the end of the day it will calculate what's your balance left. All right, so let's say you long position and the price comes down, okay, and now the value in your margin, okay, after minus off your losses, paper losses only, paper losses also you calculate on daily basis. All right, so let's say now it's at 2,005. Okay, that means you can still hold, because let's say your maintenance is 2,000 ringgit, and the floor is 2,000 ringgit. What happens? You continue to hold it, and tomorrow still going down, and now your you minus off your losses on paper, the value now in your account is only 1,005. So when it's below 2,000 ringgit, right? Now you have to top out 500 ringgit to make sure that you have the maintenance, you have that floor at 2,000 ringgit back again. All right. So you have to top it up, okay, in the next day or whatever the broker tells you to do lah. Because if you don't top it up, the broker will have the right to force sell your position if you want to keep holding. Okay. And then some of them, if you're trading online one, they force sell automatically for you once it goes. So make sure you have enough buffer lah, all right, in your account. Can we put both position long and short at the same time? Faisal, no, you can't, because if you put a long and you short again, the short will offset the long position. Okay, if you're trading in the same month contract. Okay, but some people, they do hedging, right? You can go long on the, let's say, July contract. Okay, you can go long on the July contract, and the same time you can go short on the August contract. Okay, so the price, although it may not move exactly the same, but at least you are able to mitigate a little bit lah. All right, we call that the spread. Okay, because the price in a July contract may be different from a August contract. Okay, so later I'll show you an example. Futures sound risky. Yes, it sounds risky if you do not know what you're doing. All right, especially if you're trading on a very high leverage. Okay, so later I'll talk about this a little bit. Okay, any Sifu has become billionaire trading futures. Okay, if you read our write-up today, right? If you read the book by Market Wizards, okay, I always promote the book about Market Wizards. You know why? Because there are all those traders who are featured in that book, right? Their accounts are audited, okay, and it's audited based on their trades, okay. Because sometimes people can they can bluff lah, right? You know, they put in 10,000 ringgit today, right? They trade, they lose money, but end of the year they put in 100,000 ringgit. So your 10,000 becomes like 100,000 ringgit, but the 100,000 comes in from your deposit. Okay, so it does not really reflect the real figure. But I can show you know my account now is 100,000 ringgit, but I did not show you all the trades inside. Okay, so an audit means you actually check, right? How these guys actually make money through trading. Okay, so Market Wizards will have like 10 of different traders. Okay, and all of these traders, you will not heard of them one. Most of them you don't hear from them, because why? They make money, they retire already, enough already lah. All right, and you see that their returns are like, you know, 10,000% returns a year, 100, you know, even 100x a year also got. Okay, that's how big futures trading can be. And I'll show you in a short while, right? I give you some examples. How to pick up high returns future among the rest, right? I mean, you want to get the highest return one is where you get the highest leverage lah. Okay, of course, leverage is double-edged sword. I'll mention to you earlier. Is palm oil futures as 𝐊𝐨𝐩𝐢𝐷 futures? Yes, you need to top up if your account goes below its initial margin. Okay, where any futures is the same, whether you're trading 𝐊𝐶I or CPO or any futures for a matter of fact. Futures can only trade on commodity item. Futures can be anything. I think you missed earlier, right? So it can be on indices. Like for example, in Malaysia, you can do KLCI index futures. You can do palm oil futures. You can also trade gold futures. All right. But most of the people will trade palm oil, okay, and KLCI. Gold not so much currently because there's not much volume. So the spread is big. Okay. If I can, I show you. I can't sleep when every time I keep my future position open. Yes, 𝐊𝐨𝐩𝐢𝐲. So I'll give you an example later, right? What do you mean by keeping your position overnight? Okay, there's this thing called an overnight risk. Does the contract count actually equivalent current? You know, you have the futures price, you have a physical price. Okay, physical price is what, you know, if I really want to go and buy palm oil, like, you know, how this KL Kepong or FGV, when they're going to buy real physical palm oil, their prices are different. Okay, and because the port at different places, the prices are different at different ports also, and where it comes from also different prices. Okay, so what happens in the futures market is it tries to reflect the physical price as much as possible. Okay, until it becomes a benchmark price for palm oil futures. That's why everybody is looking at Bursa Malaysia's crude palm oil futures internationally, because they use it as a benchmark. So that means if let's say the price is currently at 2,002, right? 2,200 ringgit in the futures market. Okay, and what happens is there's another seller, maybe there's a European buyer who wants to buy palm oil, and he buys a trader from, let's say, the Middle East. Okay, because Middle East itself, there are a lot of palm oil traders as well, because they sell it to Europe and they buy it from us. Okay, so if the buyer says that, you know what, I will only sell it to you, okay, the seller says, I'm going to sell it to you at 2004. All right, at 2004. But then if I'm a buyer in Europe and I say, you know, the futures market is only 2002, all right, I might as well buy at 2002. Then if I include all the shipping costs or whatsoever from Bursa, from Malaysia to ship it to Europe, if I can make that, you know, if the cost is still lower than 2004, then I might as well buy it from the futures market. So it becomes like a benchmark price that everybody looks at. Okay, because the prices can be different. The guy can ask this seller here, the seller sell at 2004, and I ask another seller, the seller selling at 2003, another seller maybe 3,000 ringgit. So there'll be many different prices. So that's why we need to have the benchmark price. Okay, same with most of the other commodities market as well. Literally an agreement to buy actually commodity, yes. Okay, so like I said, in futures market, there are two kinds of settlement. Like for example, you are trading KLCI, it settles in cash, so there's no delivery or whatsoever. Okay, but palm oil futures, there is delivery. All right. Does Securities Tracker consider to have one session on trade US and China stocks? We are not there. That one is another discussion altogether. We'll see how. S&P 500 Bursa using the same method above. Which S&P at Bursa? Bursa does not have S&P 500. Okay, you want to trade S&P 500, has to be in the US exchange, derivatives exchange. All right. It's different. Definitely is different. I think they've not introduced single stock futures. CIMB is one of them. Single stock futures is coming lah. It's just introduction stage, but not really. I'm not sure whether they've already they already have it lah. Okay. Why trading futures like buying big or small? Okay, 𝐊𝐨𝐩𝐢𝐙, you remind me of a story, right? You know, in some small towns, I was my wife was my wife is actually from Sandakan, right? And you know, in small towns like that, you know, it's a fisherman town. You know, you literally get all the retirees there who spend hours on KopiTime or coffee shop, right? You know, they would just go to coffee shop in the morning, buy a jug of tea or coffee. You know, one whole day they can stay there, right? So there's one day I went to this coffee shop. I see a bunch of retirees, old men, right? I think about 3 of them with a computer, with a laptop. And then they were like shouting, right? They were shouting, they were discussing. I don't know, you know, in Sandakan, people speak Cantonese, right? And their Cantonese is very pure Cantonese, like Hong Kong one. So it can be very, very rough also. So they were like shouting. I was wondering, what were they doing? And I heard about, because my Cantonese is also 6:30 one, I don't really understand. So I heard about they say, "Xiong ah, xiong ah, xiong ah, xiong ah," you know, it means go up, go up, go up, go up. I said, hey, are they betting on horses or what? Okay. Then when I go and look at their screen, they're actually trading futures. Okay, it's as though that when they shout louder, right, say xiong ah, xiong ah, the price can actually go up. Okay, so I mean, for them, it's like they got money, they got nothing to do. It's like betting lah, like you say, right? Buy big or small, buy up or down. So they just buy. If it goes up, means they sell, they make money, and probably buy another jug of coffee. Okay. But if you want to be consistent in trading and make profits consistently, you need to have a trading plan, right? So like I said, trading in shares is the same thing, right? Some people treat the share market or futures market like a casino. Okay, and these people are normally the ones that's going to lose money lah. Okay, because casino, when you go to casino, it's all based on luck, right? It's all based on luck. But when you have a strategy, an investment plan or a trading plan, whether it's a stock market or futures market, then you will not call yourself as a gambler, right? Because you actually have certain edge. You actually analyze things. You become a professional gambler. In trading, professional gamblers are basically like traders lah. That's what we normally joke on. All right. Okay, let me go on. Multiplier, yes. Futures trading will be purely based. Yes, futures trading, because it's fast. Okay, there's no time for you to look at fundamentals or whatsoever. But sometimes news can be very important, right? Especially certain announcements. For example, if you're trading, let's say Forex futures or USD futures. Okay, of course, announcements that comes in, because US got a lot of economic data and all that, and this can affect the futures. Palm oil also have, right? Because every 10 of the month, MPOB will release the production, the inventory levels, okay, and all this will affect prices as well. So sometimes there are certain period that we may not want to trade unless we are fully confident that the news is not against you. All right. So, but normally technical analysis, like, because we want to look at prices. Looking forward, hopefully we can run a futures class in the future. How if really can't sell? Okay. No, you can sell. It's only that your spread is going to be big. For example, if let's say the price currently is 2,300 ringgit, okay, and you want to sell, right? But the buyer only want to buy at 2,002. So you got no choice, right? You have to sell it at 2002 or you let it expire. But the moment you let it expire, then you have to take delivery. Okay, what's the book name that you mentioned? It's called Market Wizards, okay, by Jack Schwager. It's on the title. If you read our title and the content there, you should know. Have you announced the membership fee, Kin Boon Chong? Okay, fantastic. What we will do tomorrow, we actually send you guys who actually got those who are using our Equity Striker platform, we will send an email individually to you. Okay, we'll provide you a link where you can look at it, and then we're gonna send it tomorrow, lah. Right? And then tomorrow you can come back to us if you have any questions. You can also WhatsApp us if you have any questions. All right. And then on Friday also we'll be around, so you can ask us questions after that, lah. But you know what? For those who are asking whether how you want to continue your subscription, we already come up with a package, but we will send the link to you tomorrow, the details to you tomorrow as well. All right. The maximum losses per contract initial margin, assuming your fund is initial margin. Yes. Okay, but remember there's a maintenance margin. All right, that one that's your maximum, because if not, you have to top it up. Okay, if you cannot top it up, it will just basically force sell to you. Okay, so I guess I've answered all the questions. Fantastic. Okay, now there are a lot more questions as we go on, but remember, because we cannot do everything at one go, so there'll be another few more sessions, right? At least another 3 more sessions about this. All right, for you to get to know what futures trading is all about. Okay, so now there are 5 reasons basically why most traders trade futures, right? Now, because if a full-time trader needs to make income every month, all right. Now, if I'm going to have an income every month, of course, if I do investing, unless my dividend is enough to cover my expenses every month, which you require a lot of capital, then it's fine. All right. But if I need to make money every month, okay, whether it's in a bearish or bullish market, I need to look at other products to invest or trade. Okay, so futures is one of them, because the thing about futures is there's opportunities to make money in both directions, whether price go up or go down. All right, so if you expect the price to go up, then you buy, you go long. So the price go up, you make money. Okay, if you are bearish in the prices, you go short, and the price comes down, you still make money and you cover your short. All right. Okay, let's say for example, just an example, because CPU has been quite volatile in the past 1 year, just 1 year itself, not even 1 year, just 6 months. Okay, so if you look at this price, right, palm oil futures was trading about 2001 in October, 2150, right? And within 3 months, the price went up to 3001, above 3001. So 2001 to 3001, that's about 50% jump in palm oil prices. Okay, 50% jump. And then from 3001, what happened? In early 2020, right, which is this year, the price came back to 2002. You can see there's a big movement, right? So let's say I have a trading capital of 6,000 ringgit, right? I'm going to show you 6,000 ringgit, and let's say I'm going to go long here at 2002, which is somewhere over here. Okay, and then I'm gonna, when the price went up, it goes up all the way here to 3,000 ringgit, I'm gonna sell at 3,000 ringgit, let's say. Okay, so I'm gonna make an 800 ringgit profits. Okay, 800 ringgit per ton, because remember the price that you're trading here is per ton, right? So if you're trading one contract, you take 800 ringgit, which is your profit, right, times 25 metric tons times one contract, because now I'm trading only one contract. So just by trading one contract in 3 months, you're able to make 20,000 ringgit. If you're in the right direction, right? If you're in the wrong direction, of course, you can lose that 20,000 ringgit also. Okay, that's why here your trading plan needs to be very, very good. Okay, then only you are able to make that kind of money. Okay, so 20,000 ringgit. So remember, your trading capital is 6,000 ringgit, right? And you are able to make a profit of 20,000 ringgit because of that leverage. Okay, so your returns on your capital is actually 233%. That means your profit is actually 26,000, 20,000, right? You divide by this, it's actually 200%. Okay. In fact, it's actually 300%. I did a stock calculation one, so I minus off this, because this is your pure profit already. That 20,000 ringgit is your pure profit, so it's already about 300%. Okay, 300%, and the duration is only 2.5 months. Okay, so can you see the price? So the price itself moved about 50%. All right, move about 50% from 2,002 to 3,000 ringgit. But because you're trading like 6-7 times leverage, So that's why you get a 20,000 or 200, 300% profits. All right. Now, what happens if, let's say, the price comes down, you start to go short? Okay, short at 3,000 ringgit, and when the price comes down to 2,003, you cover your short. You make another 700 ringgit. Okay, let's say your trading capital was still 6,000 ringgit. You make a profit of 70,000. That will give you actually nearly 300%. So again, I did a calculation wrong here because I minus off the trading capital, okay, the profit here, because this profit is not value. All right, it's profit. So 17,000 ringgit profit. So 6 times 3 is 18,000. So this is nearly 300% returns. Okay, and the duration is 2 months. All right. Now, what happens if, let's say, you started, I accumulate it from the long position to short position, right? Because remember, I got 6,000 ringgit capital, and the first long position I make 20,000 ringgit. So I have 26,000 ringgit capital now, right? Okay, so I shorted and I make that 700 ringgit, and now I make a 70,000 ringgit profit, because this time I do not trade 2 contracts or 1 contract, I trade 4 contracts. Okay, so I get a profit of 70,000 ringgit. So 70,000 ringgit from your initial capital of 6,000 ringgit, 6,000 to become 70,000 is more than 10 times. All right, it's more than 10 times, so 1,000% in just a matter of 6 months. If you get it right, so I'm just giving you a scenario where you are able to cash near the bottom and sell near the top, and then from the top you go short and sell near the bottom back again. And this is how fast futures trading can be. Okay, because you're trading on leverage, right? Okay, so now let's take a look at the other reason why people want to trade futures is because of its volatility. Okay, so if you look at, for example, CPO, the volatility, I did an average, right? The daily volatility is about 30 to 114 ringgit in the last 5 years. That means some days is 30 ringgit movement, fluctuation daily. Some days it can be 100 ringgit movement daily. All right. So sometimes it can be very volatile. Okay. So that 30 ringgit, 114 ringgit, right? The movement itself allows you to make profits even intraday because you're trading on leverage. When you're trading stocks, you don't have leverage, right? So if the stock move, let's say you are trading stocks and the stocks move, let's say 2%, right? That's how much you make, 2%. Okay, but if you're trading futures, if the price goes up 2% that day, you take 2% multiplied by the leverage, let's say 8 times. That means you're making 16%. Okay, so the leverage will give you like a boost, right? A booster. Okay, the mean or the average, I mean, you look at a whole 5 years, so between 30 to 114 is about 55 points volatility. That's CPO. Okay, weekly volatility is 115 to 190 ringgit. There's 1 week of movement between 115 ringgit to 190 ringgit. Okay, the mean here is actually 140 ringgit. Sorry, it's not 14. Okay, and the mean here is 140. Okay, so that's CPO. So KLCI index futures, okay, 8 points to 45 points. Now the big number here, 114 on the CPO and 45 points on KLCI is because of that, that steep fall that we see in the past few weeks, right? The market has been very, very volatile in the past few weeks. But normally on a normal day, again, the mean is about 14 points kind of movement, right? About 14 points. That's all KLCI futures. Okay, the weekly movement on KLCI futures is between 20 to 62 points. So that means it's about 36 points on average weekly. All right. Now, if you compare this, let's say this is Hang Seng Index futures. Okay, so Hang Seng Hong Kong market, right? It's much bigger. Okay, so this one here, okay, is 200 to 800 points. Okay, in the last 5 years, on a daily basis, it moves. This is another points. Okay, it moves between 200 to 800 points on a daily basis. So our KLCI moves only 8 to 45 points, right? Hong Kong Hang Seng Index moves 200 to 800 points. So that one is a bigger roller coaster. Okay, so the mean is about 400 points daily. Averagely about 400 points it moves a day. So normally you see the Hang Seng Index, right? Oh, today is up 300 points. Today is down 400 points. Today is up 600, 700 points. Okay, so Hong Kong is more volatile, right? So the weekly volatility is even bigger, between 500 to 1,300 points. Okay, so it's a more volatile market if you go to the China market or the Hong Kong market or the other bigger markets. All right. So these are just some of the examples, right? I'll just give an overview what it looks like. Okay. The average, now reason number three is because of liquidity, right? You see the FCPO, for example, the daily average for the past 5 years, the lowest end is 13,000 contracts and the higher end is 30,000 contracts, okay? It gives you about, sorry, this one is the balik already. Oh my gosh. This is 7,002, this is 14,000. It's about 21,000. Okay, sorry, because I just prepared this. I'm looking at the current data. Okay, so CPO, the average is about 20,000 contracts normally. Okay, so remember, one contract itself is 50,000 ringgit in value, right? And this is only for that particular month contract. Okay, you haven't added all the volume on the other contracts. Okay, because remember I told you there's May contract, June contract, July contract, and so on. But this is only one, which is the active month or the third month contract. Okay, so the mean is about 21,000 contracts. So if I'm trading 2 contracts, it's already 100,000 ringgit. So if you want to see what's the value like for that particular month contract on a daily basis, you take 21,000 contracts, multiply by the price, and multiply by 25, because 25 metric tons. That's the value contract. That's the value traded daily on that month contract. Okay, so if you're trading, let's say, 10 contracts as an individual is quite a lot, because 10 contracts, one minimum movement. Okay, if you're trading 1 contract, 1 minimum movement is 25 ringgit, right? So if you're trading 10 contracts, that means 1 minimum movement is 250 ringgit, 250 ringgit, all right? So it's you trade 10 contracts. Okay, so if you trade 100 contracts is not a problem also, because you can get in and get out easily, because the contract is like 2,000, 21,000 contracts traded daily. Okay, it means that if you are trading 2,000 contracts, 2,000 is really a lot. Right? I mean, talking about 10 contracts is really a lot. But if you're trading 2,000 contracts, that means you are 10% of the market. Okay. That one is big, but that's 2,000. That's quite a lot. All right. So there's no problem. If I'm trading 1 or 2 contracts, no problem. All right. I can get in and get out easily. Okay. FKLI, the contract month is the volume is about 4,001 to 16,000 contracts. But the average 16,000 contracts because of this past few weeks, right? Market is very volatile. You get a very high volume. Same thing with CPO also. Okay, but averagely CPO is about 20,000 contracts. Averagely on FKLI is about 7,000 contracts. All right. So liquidity no problem. Okay, now the fourth reason is leverage, right? Because remember I told you, if the initial margin is 56,000, the contract value, let's say current price is 2,000 ringgit and 40, the contract value will be 51,000, right? Because you take 2,000 ringgit current price per ton, multiply by 25, you get 51. So you take 51,000 divide by 5,006, you get a leverage of 9 times. Okay, so CPO, your leverage is 9 times. Okay, for FKLI, your initial margin is lower, it's only 4,002. Okay, FKLI, the contract value is 1 point is equivalent to 50 ringgit. So you take the current FKLI value, 1,380, multiply by 50, your contract value is 69,000 ringgit. That means if you are trading 1 contract FKLI is equivalent to buying 69,000 ringgit worth of the 30 counters in the KLCI. All right. And so that gives you a leverage of 16 times. Gold, for example, of course, you're trading US market, everything will be in USD. The initial margin for COMEX gold, the standard gold, right, is 9,200 US dollars. Okay, so the contract value, because $1 US is equivalent to 100, that's why it's called COMEX gold 100. Okay, 1 point movement of $1 US, you're buying for every contract, the price here is by per ounce, right? And you look at the gold price, for example, 1,700 per ounce. Okay, but when you enter a futures contract, your contract size is actually 100 ounces. Okay, 100 ounces. So like drinks CPO is 25 tons per contract. Gold in COMEX is 100 ounces per contract. So you take the current value, if 1 ounce is 1,007, you multiply by 100, you get 170,000 contract value. That means you put in 9,200 US dollars in COMEX on your futures trading account, you can start trading 1 COMEX gold, and the value of that gold is 170,000 US dollars. So you get about 18.5 times leverage. Okay, so every contract they have this leverage, depending on the margin, and it depends on the contract value. All right. So every contract will have its own specification. That's what you have to remember. Okay, but since we are today, I'm just talking about futures, palm oil futures. Okay. So this is how leverage can work, right? Even on intraday, so this whole chart here is 1 day of movement, just 1 day of movement in CPO prices. Let's say I decided to go short here at 2280, right? Okay, 2280, because I'm looking at charts. If the support level is broken, let's say I enter into a trade, I go short here, and I put a 20 points profit target. So the moment the price go down 20 points, let's say I cover short here. Okay, so I'm going to sell here at 2,260. So what's going to happen is what? I'm going to make 20 points, right? Or 20 ringgit. So 20 ringgit, because I'm trading one contract, you take 20 multiplied by 25, is 500 ringgit. So on that intraday itself, I can make 500 ringgit, and this time frame is only half an hour, 30 minutes. All right, I'm looking at a 5 minute chart. So this one here moves this is a 5 minute chart, not daily chart, right? This is a 5 minute chart. Okay, so that's a 5 minute chart. Okay, so again, I can make 500 ringgit here. Okay, I probably pay commission, let's say about 25 ringgit, because it's intraday, it can be lower. So 500, let's say you minus off commission, 20 ringgit, all right? For intraday, it's okay, it's quite high, but you can get lower if you want. So I net in 480 ringgit. All right. So meaning, if I short CPO, okay, and I short and the price come down 2 ringgit means 50 ringgit lah. Okay, because your 2 ringgit come down, you have to multiply by 25, because every single ringgit movement is equivalent to 25. So it come down 2 ringgit, I already make 50 ringgit. 50 ringgit, if I minus off my commission, I still make 30 ringgit. That means with just 2 ringgit decrease, that means from 2,280 and the price go to 2,278, I can make 50 ringgit. Minus off your commission, let's say 20 ringgit, I still make 30 ringgit. And that can be, from 2280 to 2278, probably take maybe something even less than a second. Okay, so that's how fast you can make. So there are a lot of intraday traders who buy and sell, buy and sell, and buy and sell. And this was what I was doing 20 years ago. Okay, buy and sell. So make 3 points, 4 points, take profit. Make 3 points, 4 points, take profits. So sometimes that's why one full day there, you can make like maybe 20, 30 trades. All right, and this is only one product. All right. Okay, so imagine your initial margin was 5,006, right? And you already make 500 ringgit in that short 30 minutes. So 500 ringgit against, let's say, that 5,600 capital that you put in is your capital. You're making 8.9% in just that 30 minutes. Okay. So if you ask me, can people really make a lot of money in futures? Yes, but people can also can lose a lot of money in futures if they do not know what they're doing. All right. Because leverage is a double-edged sword, right? Now, let's say example, okay, this is what happened. This can answer one of the questions earlier as well. Okay, so this is a 5 minute chart, right? So Alvin shorted here at 4:30 p.m. About 4:30 p.m. here, he shorted at 2244. Okay, the price came down, he happy, but hasn't sold yet, right? Still holding. And then the price came up and Benny long here at 2244. Same price, right? Same price. So Alvin is short at 2244 and Benny long at 2244. The price went up and then it started to come down and then it closed here. So both of them did not sell their position intraday, right? They still hold a position. So the price closed at 220. So on paper, because Alvin shot at 2244, right, he made 14 points. So that means he makes 350 ringgit. Right now, on paper only because I haven't exited yet, right? On paper, he makes 350. Benny here loses 350 ringgit on paper. All right. Then hold it overnight, right? Because the market CPO closed at 6 p.m. Okay, and then open backs in the morning next day at 10:30. Okay, so now see what happens here, right? Suddenly the market just morning it opened, it gapped down. The closing price was 2230, and the opening here suddenly 2173. Okay, here what happened is maybe the oil prices fell down like crazy because crude palm oil, and crude oil prices has some correlation, right? Because of biodiesel, their common asset, the common commodity is biodiesel, right? So that's why they follow quite closely. Not all the time, but most of the time. Right. So now imagine, okay. So because Alvin shorted and the market favors him, okay, because the price came down and now makes 71 points, all right, or 71 ringgit. So 71 multiplied by 25, he makes 1,775 just because the market kept down the next day. Okay, but for me, because I was in a long position, I'm going to lose 1,775. Okay. So those who cannot take this kind of big movements, and for some of the futures contract, for example, like palm oil or many of the others, they tend to gap up and gap down. All right. So a lot of people, they want to trade intraday. So make sure they sell before the market closes at the end of the day. Then you will not get into this, what we call this overnight risk. Okay. Now imagine if I long here, right? If I long here and at night after 6 p.m. when the market closed, I can only pray and look at the US markets and pray and hope for palm oil prices to go up or soybean prices to go up, because then at least I'm safer. Okay, but imagine let's say 12 a.m. midnight, okay, and then suddenly you see crude oil prices plunge down. That's it lah. I cannot sleep, I cannot eat already, because I know I'm going to lose money on CPO the next day. Like what happened here. Boom, come down like this, and I lose 1,007 just like that. Okay. Okay, so that's leverage. So leverage is a double-edged sword. You need to know how to manage it. Okay. Now, in the coming series, we'll let you know how lah. We go into more details. All right. So this is just give you an expectation. Okay. So this is easier than stocks because number 5, the reason why, because you don't need to pick the right stocks to buy. Palm oil futures is palm oil futures. There's only one. Okay, but different month contract. Or KLCI futures. Okay. If I want to go other futures market, you want to trade international market, I also can. I don't need to pick them because they are already there. I just need to know when to buy and when to sell only. All right. So the analysis part, I don't need to do a lot of fundamental analysis because there's no point doing fundamental analysis when you look at short-term price movements. Okay. Short-term price movement is all a lot of speculation, right? It's very noisy. But long-term you'll see a trend. But short-term you don't. Short-term is basically speculation. Okay. So now, if you want to get more information, you just go to bursamarketplace.com. So first thing, you click on this learning here, like a hat, and then you click on Start Futures, and then you will show you, there's some tutorials, some videos, some information you can find over there. Okay, so you go to bursamarketplace.com. If you want to know how to open an account, you still go to bursamarketplace.com. You go right at the bottom. I think they should put this right at the top, right? Put it right at the bottom and click on this open a trading account. All right. And then you get to this page. Okay. There are two here, there's securities and derivatives. So securities. So if you have a stock account, it doesn't mean that you can trade futures, right? Futures is a separate account that you have to open. Okay. So click on derivatives and then you fill in and you can select broker and whatsoever. And the broker will start to contact you, and you just talk to them, right? See whether they're able to fulfill or provide the service that you want. All right. So that's futures. So, of course, right now it's futures market is really it's all about leverage. So of course you can make money a lot. You can also lose money a lot. So for those who want more excitement, then of course this will be a good product to look at, right? Because there are many ways you can actually leverage them. All right. Okay, let me take a look at some of the questions right now. Okay, I'm just gonna go very fast because don't worry, because we're gonna continue with this again, right? In the next 1 or 2 weeks. All right. So just bear with us for a bit. Okay, if there's any questions, just write it down. If I'm not able to answer right now, I'll try to answer you in that in the chat line, in the comments. Okay, well, I think I'm really out of time. It's really 9:15. The Mandarin session is going to start. Okay. Okay, guys, I think I lost the questions really. Anyways, I hope that you get some insights on the futures market. I'll try to answer the questions on your comment section in a short while. Again, like I said, be with us. We're going to continue this session in the next 2 or 3 weeks, or maybe a month, so that we can cover what you need to know. All right. In the meantime, you can ask questions there. If the questions that you ask is going to be covered in the next topic, I'll just say that we're going to cover this next. All right. Other than that, I'll try to answer your questions. Okay, so again, for those who are with us, who have used our Equity Tracker platform, we know that it's going to expire tomorrow, will be our last day of using it. All right, we'll send an email or a note to you personally to give you a link about the subscription. Okay, this is especially for you guys, so that if you want to continue, then you can just click on the subscription and then subscribe from there. And if you need any more information, just contact us in your WhatsApp or even PM us on the Facebook. All right. So guys, thank you very much for joining us. I'll see you again in the next futures copy time. All right. Have a good evening.